What's up, everybody? It's Jonathan Rose, owner, Masters in Trading. I want to talk about one of my favorite trades. And this is one of my favorite trades because the margin is so enticing and the trade, at least in my eyes, is really reliable. Let me show you how it works. So here it is. Heating oil against RBOB gasoline. Two highly correlated products. And you can see right here, heating oil minus RB. Now I have you going back to May, so about 5 months. And as you can see, it's been a range trade, right? We start here. We call that the zero line. It's a zero line because if you put on the trade on that date, you start at zero. If you're short and it goes down here, you would be up 5 grand on the trade. That's just how the chart works. Hopefully that makes a little bit of sense. But you can see going back to May, the trade really hasn't gone anywhere. It's just stayed in a range. Now, the reason I like this trade so much is if you just hang around the edges. When I teach any kind of relative value trading, any kind of correlations, you're waiting for those correlations to break down. When those correlations break down, you could potentially find a trade. Now, the key with this kind of trading is patience. You don't want that FOMO. You don't want to feel like you're going to miss out. And then you end up on a rally like we have right up here, buying like you're going to miss out. And then it becomes a very difficult trade for you. Instead, try being robotic. Try patiently waiting until levels that you want present. Now, the thing I like so much about this trade, I mentioned this earlier, is going to be the margin. Look at the margin. So the margin on heating oil is 4,730. The margin on RBOB is going to be 5,500. So if you just did both of these together, it's about $10,000 of margin. But that's not what we're doing. If we buy one and sell the other, we have on a spread trade. The chart that I'm showing you is charting the spread trade. Now the margin on the spread trade is not the 10,000, what is that, 230? The spread margin is 4,557 for maintenance. And then for the initial requirement, it's 5,013. So just look at it as $5,013 in margin to put on this trade. Now, this is why this trade makes so much sense. This is why it creates so much opportunity. On Edge Light, again, this is a proprietary software that Pablo Lucena built. The way that we look at the spread is we don't look at the value of the spread. Instead, we look at the only thing that matters to us traders, and that's real money. So if I made a trade and bought this at negative 5,000 and I get out at negative 3,000, I make 2 grand, right? So I make 2 grand, $5,000 of margin, not bad. Now, this is something I was talking with my coaching clients. It's one of the most difficult things for me as an educator because I'm always getting questions of what kind of returns can I expect? How good of a trade is this? What kind of returns can I expect? And if someone is looking at this trade, HO against RB, they see a video like this, they see, okay, 5K in margin, pretty cool, I want to try it out. And maybe they get in here and they get really frustrated, so they start angry trading and loading up 3x3, 4x4. Well, the trade goes against them. They blow up their account. They lose 20K. They have no clue what they're doing. They hate me. They're frustrated. Well, that's one person's return. The same market, different trader, trader with experience, trader without FOMO, that fear of missing out, a trader who's patient. Well, that guy might just nip around the edges. Buy when it goes offered, take it off when there's a little bit of profit, It gets up to the zero line. Maybe he doesn't really have anything, so he just waits around for the next opportunity. It goes really offered. He gets in. He takes it off. It goes offered. He puts it on. Maybe he takes it off. Maybe he doesn't. But maybe he adds another one down here and takes it off, and he keeps playing this game. This guy might be up 50, 100, 200 grand. Who knows? Just using it as an example. So the same market, two different traders trade things a little bit differently based upon their patience level, based upon their experience, based upon what they've experienced in the past. We call that building your memory bank. Trade on the edges, nip around, but don't get caught in the muck, in the middle. Let's look at things a little bit differently, guys. On the bottom is going to be our spread, HORB. So the light blue is exactly what we just looked at, okay? Right? It was a range trade going back to May, about 5 months. Well, what I've done up top is I put HO and RB as two outright contracts because I wanted to see how they present on a chart, how they look different. Now understand the top two lines, these guys, is the same exact thing as the bottom spread. The only difference is we're looking at them as two individual contracts, right? RB and HO. And down here, we're looking as one contract, HO minus RB. Let me explain how this works. Again, look at the P&L swings if you're using the outrights. A lot more risk, right? But the margin's still about the same. So I definitely prefer trading the spread. Now earlier we talked about this being the zero line. This being the zero line. The zero line is if you were long one, in this case if you were long one heating oil and short one RBOB, and this presented right here, you'd be at break even if you got in when the chart started, right? You can see they're right on top of one another and they're right up to the zero line. Well, when the spread goes offered, like it did, it creates a separation between those two outrights. When it comes back up to that zero line, that's right here, you can see they come back and trade together. Here they separate, here they're separating, right? But eventually, at least in my opinion, it's going to come back to trade to that zero line. What can we make? Well, if you initiate a trade right now, you buy one HO and sell one RB at the 3,439 level. If it rallies up to zero, you can make 3,439. But now, you got to ask yourself, how volatile is this spread? We already know the margin's about 5K, right? That's what it is right now. If there's more volatility, that margin might go up a little bit. If there's less volatility, less expected move, that margin might go down a little bit. But let's look at some history so we have some perspective about what can this spread really do once it starts moving. HORB, I take you all the way back to 2015. Now in 2015, if you were long this spread and held it to this date, you'd be down $30,000. I don't expect you to hold this trade for 5 years. But what I want you to see is the mean, the average of the spread has been right about down 10,000. Before the pandemic hit, it looked like it was trading about negative 15,000. Spread got killed. Then it rallied monstrous, right? It had about a $30,000 rally on a one-by-one. A $30,000 rally with only 5 grand of margin. I'm sure the margin was pretty juicy then because of the risk. It traded right back down. But right now, if we look at the behavior, going back here, this is the lowest it's ever been. So all I'm doing, guys, is I'm just trading HORB from the long side. I'm not willing to sell it. And I'm not willing to sell it because I know historically the mean where this spread lives is quite a bit higher than where it lives right now. Right now, we're going through something that's been unprecedented, certainly unprecedented in the last 5 years, right? There's a pandemic. Energy contracts have been getting killed across the board. that too will change. So again, this is Energy Edge. Down in the video description, I'll leave a link. You can just go to mastersintrading.com, learn more about Energy Edge. You'll learn exactly why we built this product. But if I take you back to that first chart and we just show the spread between HORB going back to May, about 5 months, remember, I'm just looking to get long this spread. So for me, which I am long this spread right now, I stay long a core position, but when it goes offered, consider buying another one. When it goes bid, you sell that second one. So it might look like HORB. Your position might look like long one, short one, as your core, trying to hold for a big move, possibly get one of those $25,000, $30,000 moves. But then when it goes offered, you add another $10,000 of margin. When it goes bid, you take off that other one and you slowly start to lock in money. Each one of these little moves is $1,500. Okay, take $1,500 away, put it in your pocket. Take $1,500 away, put it in your pocket. But you're holding the core, waiting for that big move to happen. Will it happen? I don't know. But you know what? HORB has lived much higher than it's trading right now. So I certainly like the risk versus the reward. Hope that helps. Please, any questions you have, leave a comment below. I'll make sure to answer each question. If you enjoyed this video, please subscribe and give it a like. It really helps, guys. My name is Jonathan Rose. I'm the owner of Masters in Trading.